when you're shopping an interest rate, it doesn't matter till you get an offer accepted on a house.
All right. Hey, it's Ashley with Keller Williams Real Estate, and I'm here with Ray Batalona. He's with BECU, and we're going to talk about this really interesting topic. So if you are a first-time home buyer, you've probably heard a lot about first-time home buyer programs, and you probably wonder, do I qualify for any? And so that's what we're going to talk about here in this video. So welcome, Ray.
Thank you for having me, Ashley. I appreciate it.
Yeah, awesome. So Ray, maybe you could tell everybody just like a little bit about your background, and then we'll get into the presentation.
Well, I appreciate that. This is my 19th year doing mortgages. I started on the broker side, out with different brokers back in Woodinville, 2006, 2005 time, and really changed in the market when the market crashed in 2008, 2009. I decided to go into the banking side. Went to work for Flagstar Bank and US Bank, two of the big national banks in that case, to kind of get some experience running some different branches. And then after that, I decided to come work for the biggest credit union in Washington State, in BECU, and really kind of understand what a nonprofit organization is about, educating membership and making sure that we're taking care of people in the mortgage side as well, not focused on making money per se, but making sure they're taken care of when they're trying to buy their first home.
It's wonderful. I know BECU is like, they're really well known actually for their first time home buyer programs. And so I think it'll be, it's great. And they do a lot of good work. It's huge. It's a huge, huge nonprofit, I think is really, that's
yeah. I think with all the stigma around banks right now, and a lot of the changes on the broker side, with a lot of the companies going through different changes with government changes, as well as just regulations, that it's nice to have a credit union who's been around a very long time. And also, not only are they the largest, BECU being the largest in Washington State, but we're also the fourth largest in the United States.
Wow.
I think a lot of people don't really understand that about BECU, that we lend outside of Washington. So we're really trying to grow a lot more than people understand. And other than the largest credit unions, which are all backed by a federal government, like Pentagon Credit Union, stuff like that, BECU stands out because of our connections and who we are. So it's nice to be affiliated with them.
Yeah, it's wonderful. Yeah, they do a lot of good work. So topic in hand. So tell me, what's a first-time home buyer? I mean, I've heard some things. I've heard that you could become a first-time home buyer after already being a first-time home buyer.
You can actually. So the definition of a first-time home buyer is someone who is going to be purchasing their primary residence, and then someone who hasn't owned a home in the last 3 years. So if you are someone who's already owned a home, and let's say maybe you sold that home previously, moved to a different state, or maybe had some downtime where you've been renting for a couple years, the goal is really to reestablish you back into the market for home buying. And in that case, if it's been 3 years, you are considered a first-time home buyer again.
Wow. Yeah. That's interesting. That's really cool.
It is. And there's also another kind of caveat in regards to that, where if you are a displaced spouse or a single parent who's been displaced, maybe you went through a divorce or something to that extent, and you were on the title of the home with your spouse, and now you are moving on by yourself, and you are starting your own life, and you need to purchase a house yourself, then you might qualify as a first-time home buyer also, which is a very unique situation for some people. So
okay, well, that's cool. So it sounds like potentially a lot of people could qualify. It just depends on whether or not they've owned a house in recent time.
Exactly. That's the main key. If you own a home, then obviously you wouldn't qualify for a first-time home buyer program. But if you haven't, it's definitely good to know if you do.
Okay, cool. Now, frequently in my work, I meet a lot of people, they're first-time home buyers. They've never bought a house before. And they often ask me, hey, like, which first-time home buyer programs can I do? And I think maybe it kind of depends, but you can kind of like go more into that. But, like, who is like, like these incentives, like who are they primarily trying to target? Like obviously first-time home buyers, but I think it's a little bit more than that, right?
So it is. And just to be honest, every lender has different programs they offer. BECU is, since we're non-for-profit, I also like to joke around, we're very conservative in regards to the risks that we're willing to take as a financial institution. So on that topic, we decided to create our own first-time homebuyer program. because a lot of the first-time homebuyer programs that are out there actually attach a second lien to your home, or require some kind of payback to some extent, whether through a lien or through equity in the home, depending on the type of homebuyer program. So BECU really wanted to create something unique to their membership and the market to really give first-time homebuyers free money to some extent, as long as they kind of go through the qualifications that are needed. But in regards to who it's targeting first-time homebuyers who have little down payment is the main thing. First-time homebuyers normally don't have a lot of money saved up, or based on the market, they don't have a lot of money to put down or deplenish their savings in order to afford a home. So the minimum down payment is 3%.
Okay.
The maximum down payment is 5% on the BECU first-time homebuyer program.
Okay. Well, that's good to know. And so if you have like a 20%, it's kind of like, congratulations.
Yes. I have to explain that to buyers all the time, is if you've saved up 20%, it is really a congratulations. You've done a great job saving your money, but it's also a time to discuss, is it beneficial for you to put the 20% down, or maybe still only put 5% down and get some free money?
Yeah, you have to make that decision. Yeah.
You really do, because how much of a monthly savings is it for you to put the 20% down and eliminate the PMI compared to, eliminating all your savings?
Surely. And then it's like, it's a bigger financial question, actually. Like,
It
what's
is.
the future look like? What do I want to do in 10 years? What do I want to do 20 years, right?
Yeah.
That's interesting.
First-time homebuyers have a hard time saving money because, we have inflation right now. We have a lot of other factors that kind of come into play that prevent you from saving the type of money that you need to save to afford a home in our market. So with BECU, everything is driven based on income limits, though, based on the county.
Oh,
So
right.
that is a huge factor. And honestly, every first-time homebuyer program, for the most part, that I know of, is based off of income restrictions. So that becomes a huge factor in our area and what you can qualify for. Because if you make too much money,
Right.
even if you're a first-time homebuyer, you then don't qualify for the programs.
Right, right. So it's kind of like it's a multi-layered, right? Like, so it's like the first basic thing is hey, you haven't owned a home in 3 years. And then it's kind of like, well, how much down payment do you have? What's your income like?
Exactly.
And then you would find out if you actually qualify for a program that like BECU, for example, would offer.
Exactly. Yeah.
Okay.
And there are some other first-time homebuyer programs, the Washington State, grant program. There's some federal programs out there. All of them have different restrictions. All of them have different income guidelines that based on the county, the number of people in the household, different things like that. But for BECU, it just comes down to the Fannie Mae Home Ready income limits is what we use. So for Snohomish, King, Pierce County, that is normally around 124,600 is the 100% mark.
Okay.
And then 99,600 is the 80% mark. So those are the key marks right now for this year.
Okay. Well, that's pretty straightforward. Okay. So maybe we can kind of talk about like preparation, right? So maybe, maybe this person is like thinking, hey, I want to start thinking about this. I'm just kind of researching, what are some things, like what are maybe like the top 5 things they can do to get ready?
Well, I like to say the number one thing you should do is talk to a mortgage advisor first.
Sure.
And I say that in regards to, I don't like to start off with a pre-approval. A lot of people think I just need to get pre-approved right away. Let's go ahead and start the application, pull the credit. That's not always the best route to go.
Okay.
A pre-approval is only good for 120 days. First-time homebuyers sometimes need to plan 6 to 12 months in advance. So I suggest you sit down with a mortgage advisor. You really go through your scenario. A lot of times that mortgage advisor can advise you, should you pay off some debt with your extra money, or should you not pay off the debt because you qualify for what you need and you need to save more money then in that case. So I really think starting off early to talk to a mortgage advisor and create a plan for yourself. That's the number one step. Other than that, saving early. A lot of times buyers think that they can save up a certain amount of money before they purchase the house. But as a, part of the process, we need to verify you have the funds. So if you're getting that as a gift fund from a parent, that's a different story. That can be verified later. And we can just approve you based on the assumption that you're going to get a gift. But if funds are in an account, we need to verify that. So it's also smart, don't move your funds around. It's very hard to track. A lot of first-time home buyers, I moved something from BECU over to Bank of America or Wells Fargo, whatever the case might be. When you do that, it's very hard to track that information. So know that we want, the 60 days bank statements, and the least amount of activity as possible is going to be better for you as a client too.
Yeah. Well, a lot of
So,
people don't know that part, right? Like they've never been pre-approved for a mortgage or gone through like the underwriting process. And so it's like if you're, they don't realize that you guys look at every bank statement, and you need to see like where basically every dollar has moved and where it came from.
correct. And you can't black anything out. You can't, omit it. You can't, anything to that extent. We have to see it all. So it's important to know that beforehand. And so if you need to transfer money into an account, part of that planning goes into talking to that mortgage advisor, right? Like if I have money in cash, which you cannot do, you need to know you need to deposit that money. It needs to be seasoned in your bank account. And you can't do that if you don't talk to a mortgage advisor beforehand to learn that part.
Yeah.
So I would say a kind of a 1B or 1A of that, step would be understanding the mortgage process and understanding the real estate process. It's important as a first-time home buyer, you honestly have no information on that. So the more educated you can get about both of those processes, what's earnest money? How does it apply to my mortgage? I get the question all the time, do I have to do an inspection? It's not a mortgage thing, but it's a mortgage thing if we're doing FHA or VA because it's included in the appraisal. So different guidelines, different things, talking to the advisor, creating that plan kind of solves a lot of those things.
Yeah. So I think what I'm hearing from you is like really like it's really important to get with a mortgage professional first and just have a conversation, because there's a lot of different situations.
Correct.
And they'll help you, sort of like make suggestions about ways to become more prepared. Or maybe you might already be ready. Who knows, right? But you have to sit down and figure out like, okay, where are you?
Yeah. And I actually have people that all the time, they come in, they feel they're super unprepared. They're very nervous. And then we sit down for 30 minutes and I tell them, you're more prepared than most buyers I see that have been practicing for months. And, you didn't realize it and then next thing you know, they're ready to buy a house next month. And they're like, let's start the approval. And it's like, oh, okay. So it depends on the situation, and getting that information is good. But the mortgage advisor gives you information that you then do your due diligence on later, like understanding credit scores, understanding that a consumer score that you see on Credit Karma is not your mortgage score.
Yeah, that's interesting.
That's a very important thing that most clients don't know, especially first-time home buyers. I get the same thing all the time. I track my credit by Credit Karma. It's an 800. See, an 800. I have an 800 right here. Okay, but that's the consumer score. That doesn't show you all three bureaus.
Yeah, because I remember that. Because what do they do with the mortgage? I think, do they take like your lowest, or do they like average them? They do something, right?
So they actually we pull all three scores,
right?
Equifax, Experian, and TransUnion, and we use the middle of the three.
Okay,
and we use the lowest middle score of all the borrowers. So if you have 2, 3, 4 borrowers, the lowest score, that's the middle score out of all those borrowers, it's what's used for mortgage purposes.
Right. So if there's 2 people, you're looking at 6 scores and you pick the lowest middle score.
Correct.
Interesting.
So it's a very confusing thing for buyers who've never heard that before.
Oh yeah. So you mentioned the people that come to you and they're like already prepared. Like what things have they done that's like, boom, they're prepared. So like obviously they've probably saved their down payment, right? Or maybe they have like good credit. So what would those things be?
So I mean, saving your funds in one account is kind of a huge thing. And I know that seems funny. Multiple accounts, sometimes you have money transferring around, you have different systems to use for that. A lot of times, if you put all the funds that you're going to use in the financial institution you're going to go through, it also makes it easier. For example, BECU has an internal wire policy that if your funds are within BECU, on your purchase, you just fill out a form and we wire the funds for you for free. So there's no, going into the bank to complete a separate wire, to worry about wire fraud to the escrow company or anything to that extent. It's completely behind the scenes for free. So a lot of times what confuses borrowers is I need to liquidate stock and then I need to transfer it here. That all takes time. So the more you prepare for that, the more everything is ready to go in one account, the easier it is documentation wise and just for the process.
Okay.
So that aspect of assets, and then really depending on your employment. Are you a regular hourly salary employee that has been at the same job for 2+ years? That makes it easiest. If you've switched jobs, that's not necessarily a hard thing, but we are then documenting each W-2. We're documenting each, the pay stubs for those that employment. And that's a big thing that a lot of buyers don't know. If you have not worked at the same location for 2 years plus, you cannot use overtime, commission, bonus, part-time income. None of that stuff can be used. So when you're switching jobs and you're thinking, I'm going to make more money, therefore I then want to go buy a house because I'm going to make more money. But most of your money is based off of a bonus or a commission structure, or maybe even stocks and RSUs. You can't use any of that until you've been there for 2 years.
Oh, 2 years. That's interesting.
Because it's going to 2-year average that income, specifically that income.
Okay. So what if, on that, so like, what if it's with the same company, it doesn't matter. Like, cause I imagine there's some companies where you can be in a certain position and then get promoted.
Of course.
And then like part of that benefit package might be some bonus or whatever. Are you able to just apply that right away because it's the same company?
Yes. Same company.
Okay.
That's okay.
Same company?
That's
all good. Okay.
That's more of a role change or position change.
Sure. Okay.
So, and then in that case, although you have a new commission structure or bonus structure, we can basically show that that's going to be kind of approximately what it is and use just an average of that.
Okay.
But when you switch positions, let's say you work at a car dealership and you've worked at a car dealership your whole life, and you got a better offer over at Ford instead of Chevy. And you're like, hey, Ray, I'm still doing cars. I've been doing it my whole life, but you're now at a different dealership. We don't know how your commissions are going to be. And if you're all commission based, guess what? Now you have no income. So it's important to know that, because anytime during the process, maybe you get a new job offer. And if you want to buy a new home, how does that affect that buying of the home?
Correct. Right.
Yeah.
Yeah. I mean, that's something that I tell my clients a lot, like, especially when they're getting close to being in escrow, like, don't change your job. Everything about your financial condition, the way it looks right now, needs to look this way at closing.
Exactly.
Yeah. Has to look the exact same. Okay. So I heard from you, having all the savings in one account is great. Having 2+ years of employment at the same place. What else? Like, basically, good credit. Like,
working on credit is good. It's important. Understanding the government just changed those credit guidelines, right? So the higher your credit score. So talking about credit, mortgage scores are a stricter model. They go from a 450 to an 850. Okay. The consumer score is a 350 to a 950. The mortgage is also a lifetime score. So it's important to know that anything over a 780 on a mortgage credit score for that middle score is considered perfect.
Well, you know what? So I didn't realize they were on different scales. That's interesting.
And then below that is all to 20-point increments. So 760 to 780, 740 to 760, all the way down.
Okay. And so it gets translated, right? So your consumer score gets translated to a mortgage score when you pull the credit.
Yes.
Is that right? Okay.
Well, not necessarily translated. They're different scores completely.
Oh, it's a completely different score.
Completely different model altogether.
Oh, wow. Okay. So this is probably a separate video, so I won't even go into that, but that's really interesting. We'll just put a pin in that. Okay. But let me ask you this. How should people go, like, how should people approach shopping for financing? I mean, I think like people talk a lot about like, oh, okay, well, you should go and talk to like different mortgage companies. I don't know. Like what kind of approach would you take, or what would you recommend? Like, just talk to the first person, or should they interview other people? I don't know.
Okay, so I look at it 2 different ways, and I'm honest with people. I expect you to shop me. That's okay. It's to be expected. You need to get yourself the best deal. So, but understanding what you're being offered is also sometimes very confusing in the mortgage market. So first and foremost, you should only initially get a pre-approved through one company, in my opinion. So if you have somebody that you trust, somebody that you're able to communicate with and build a relationship with, talk to that person, create a plan, get pre-approved to them. Okay. Understand though that different companies might have different programs, but each time you pull your credit, it will affect your credit score. Okay. So the people that want to shop around and have 6 or 7 different mortgage companies or a broker pull their score multiple times, it will affect your score after time.
Yeah.
Just know that.
It's funny that you say that, because I feel like I've heard before people say, if you're shopping for a mortgage and you have your credit score pulled in like a certain time period, I've heard this,
Yes.
that it's the same credit hit or whatever. Is that true? Is that not true?
Yes, it's technically true. So
Okay.
I'll elaborate.
Okay.
Let's say you apply for a mortgage and I pull your credit.
Okay.
So when I pull your credit, you have 14 days to go have another mortgage company, multiple mortgage companies pull your credit again. Now, it doesn't affect that specific score. So
the mortgage score.
Yes. So if I pulled your score and your middle score was a 782 when I pulled it,
right,
every other company that pulls it will get that 782 for the next 14 days.
Okay.
But after the 14 days is up, every one of those credit pulls affects your score.
Okay. That's
so
good. That's good to know.
Find a home, so also the credit report is valid for 120 days.
Right.
If you do not find a home in 120 days and they re-pull your credit report, all of those credit pulls have now made an effect on your credit pull, on your credit score.
Right.
So that's something you just have to understand.
Yeah.
Now, that being said, when you're shopping an interest rate, it doesn't matter till you get an offer accepted on a house.
Yeah.
That's the day that matters.
Yeah, it's the day that does matter. You have to have the offer.
Yep. So if you shop around today and you don't have an offer and you say, Joe's Mortgage over here gave me the best deal, I'm going to go with Joe's Mortgage. That doesn't mean in 3 weeks when you get the offer accepted that Joe's Mortgage has the best deal. That's technically the day you should shop around and you should check everything. Yes. So it is kind of difficult on how to approach shopping for financing in that aspect of things, because the day you get the offer accepted is really the only day that matters specifically for you to shop.
Yeah, I think a lot of people don't know that. I'm not sure what they think. I think maybe they think that the rates are kind of like credit card rates or something, where they're like, this is the number and it's going to be the number, or whatever. I don't know,
Actually,
like, it's
they think it's prime.
Oh, they think it's prime.
They think it's prime. Most clients and buyers actually feel that when they hear the feds have raised rates or lowered rates, that's the mortgage rate.
Yeah.
They automatically will reach out to me. Hey, I heard the feds are raising rates in April. I want to go ahead and lock something in. Let's get into something. That has nothing to do with mortgage rates.
Yeah.
So that is a lot of times the consumer feeling is they're reacting off of the news, and the news is always behind in regards to providing them with information.
Yeah, way behind, right? Because rates change like every day, all day.
Exactly. They changed 3 times today.
Yep. Already changed 3 times. You should do a video on that. I don't know. Look, we're getting out, but anyway, like, okay, so it would be, so it sounds like if you're going to really shop rates, or I don't know, I guess shop programs, and you're going to have a bunch of people pull your credit, you've basically got like 2 weeks, got to get that done.
Exactly.
ASAP.
Yeah.
Okay. So it doesn't affect your score.
Exactly. And when you're shopping the rate, always shop the same rate.
Oh, this is very challenging.
You want apples to apples comparison.
Yeah.
So if you get a quote from BECU and that quote is 6%, don't go asking the next lender what the best rate they have for you.
Yeah.
Any lender can quote you any rate. Most people don't understand that. If you want 5% today, I can get you 5% if you're willing to pay the fees to get the 5%.
Right. They don't know that.
Yeah, always compare apples to apples. So whatever the initial price quote you got, when you reach out to the other lender, ask them that. Hey, I'm purchasing a home. It's, 500,000. I'm putting down 20%. What is your fees for 6.25% or 6%, whatever the rate was?
It's so dangerous. That's even tough because we just said rates change every day. So it's kind of like they could literally go back to that person the very next day and it could be more expensive or less expensive.
Yeah, Exactly.
Yeah.
If
That's
you
the
called me
thing. Like
this
people
morning,
don't
you
know
called
that.
me this afternoon, completely different rates.
Yeah, completely different rates. So, okay. Well, I'm glad that we touched on that a little bit. I mean, I think it could be like, there could be a larger conversation around that. So, how about this? Like, let's talk a little bit about, you touched on it earlier about like gift funds and stuff like that. So, who can you get gifts funds from? Like, I don't know, where can you get, if you had down payment and it wasn't liquid cash, like maybe what are some suggestions there?
Family.
Yeah.
Family is the only technical place you can get, when I say place, the people that you can get gift funds from. It has to be some kind of family member, some kind of a relationship to you in regards to family. It can still be, you know what I mean, a mother-in-law or, an aunt, you know what I mean, from your husband's side. Whatever the case might be, they just have to be related to you to some extent. And they have to, in essence, fill out a gift affidavit that states their relationship to you and then the fact that they're giving you a gift. I always have to remind people, whatever you and mom have agreed to behind the scenes, I don't want to know about it. It is a gift for mortgage purposes.
Right.
That is all we're focused on.
Yep.
Other than
Awesome.
that, for down payment, really, it's just anything liquid.
Anything.
So,
as people who do retirement accounts, like they could do, like they could take a stock.
stocks, CDs. I've even had people actually sell boats, sell cars, do different things like that. As long as we can document what it is.
Yeah, like you have to show the money coming in, where it came from, and all that stuff. Yep, the
Yeah.
documentation.
If it's a sell of like a vehicle or boat, a lot of times we'll have to get Kelly Blue Book value. We'll have to show the actual receipt of the sale and different things like that. So some different documentation, but anything that's liquid, you can technically use except for straight cash.
Okay. But and it can skip the seasoning process, right? So like if you sell your boat or your car,
Yes,
as long as you are owning it, whatever, then
exactly.
you can just sell
And
it.
same thing with the gift funds. You know what I mean? So, and here's something to talk about gift funds. If you are not married,
Right.
your partner cannot gift you money.
If you're not married.
So a lot of times we have situations
because you're not really related to them yet.
Exactly. You're not related to them yet. So you have couples that have been together for quite a long time.
Yeah, they're not married yet.
Not married yet. So, but here's the trick. If your bank accounts say both of your names,
then it's not a gift.
Then it's not a gift. It's your money.
Yep.
Right. But if it's only coming from one account that that person's not on the mortgage and you're not married to them, they cannot gift you money. So then we go back to the season requirements where you need to deposit that money in the account for more than 60 days. So that way it's seasoned before we use it.
Yeah. Well, and this I think really highlights the importance of having that initial meeting, because you really need to figure out like where everything is and how to actually like move forward with the plan and figure out like, okay, does this need to go through the seasoning period? Like you don't want to like have the house you want to buy and find out, hey, you can't buy it.
Exactly.
You have to wait 2 months.
To do is be prepared. And that's why, when we talked about what's the best thing to do, it's really to just start that plan. Yeah. Whatever mortgage advisor you're using and you feel confident and you trust that person, create that plan with them to get yourself to where you want to be in home ownership. I sat down with the client last September. I did their application just the other day. They everything that we talked about, they instituted over that time period. And when she came to me, she had it all ready to go, and we did the approval, and it was all completed today. And now she's off and shopping with her realtor. So that's what you're looking for, is you want to give somebody a plan, you want to see them accomplish it, and then you want to see them come back to you so you can help them with the home ownership portion.
Yeah, it's wonderful.
Yeah.
Well, is there anything else that you would recommend for a first-time home buyer? I think we kind of touched on a lot of things. Is there anything else?
We did. I think the only thing I'd like to touch on is the talk about a cosigner.
Oh yeah. Yeah. Co-signing.
A lot of people feel that a cosigner on a mortgage is like a cosigner on a car. It is not. No. A cosigner on a mortgage owns your home with you. No. They are co-owners of the home, not cosigners.
Yes.
So the only benefit to adding a cosigner is if you're trying to qualify for more of a home and you need their income to help you accomplish that.
Yeah. Yeah. Or the credit, right?
Exactly. Because maybe that cosigner has worse credit than you, which then affects your interest rate and fees, and maybe the program you can go on. Sure. Maybe they have so much debt that the income doesn't actually help you. Maybe it's actually a negative aspect of things. So a lot of times people are like, I just want to put it on there because their credit is better than mine.
Sure.
That doesn't help you at all. Like you're still going to go off of the lower credit score.
Lower credit scores. Yeah. What about when you talk about that, what if the what if the co-signer owns real estate?
That's okay.
Would you still qualify for the first time home buyer program?
You would. Yeah.
You would. Okay.
So I do home loans all the time where mom and dad will actually co-sign for their
Okay.
kid. And the kid is still a first-time home buyer, so we can still do the first-time home buyer program, but we need to be careful about income, right? Because there's still income limit restrictions. Yeah.
Yeah. So in that scenario where you have both parents, are you able to just use like one parent?
Yes. And the same
Because you got to keep the income.
Yeah. Same thing with spouses or couples in general. If a couple comes to me and they say, hey, here's our situation, we want to qualify for a home. And I say, look, if we put just one of you on here, now we're qualifying for the first time home buyer program. You're getting free money. You're possibly getting better rates and fees, cheaper PMI. Those different options come into play with that program.
Right.
And then we can still put the spouse on title.
Yeah, they can still go on title. Yeah, 100. They just don't have to be on the mortgage.
Exactly. So do that all the time. Also, we do that when the spouse has or the partner has not good credit.
Yeah, not good credit. Yeah,
Just
if you can get away, you don't need their income, then it's all good.
Yep.
Yeah.
So it's important to know that aspect when you have multiple people that want to apply and they might get frustrated because they aren't going to go on the mortgage.
Right.
But at the same time, it might actually be a benefit to them. And they just need to really understand that and have that explanation. So it's not a situation where we just don't want you on the mortgage.
Right. Yeah. Well, it's a strategic move.
It is. It is. As well as that person also saves their first time home buyer sometimes.
Right. Yeah. It's a strategic.
Right. If you have a couple and you do a home under one as a first time home buyer, and then they need to go buy another home 3 or 5 years later, and that other person's now making more money, we can do the first time home buyer under that person now.
Yeah.
So different options to use later.
Yeah, that's wonderful. That's wonderful. Well, is there anything else to add?
I think we covered a lot of
we did. It's a lot. This is a lot of information. So if you've watched the video, they should go back and rewatch it because no, seriously, like you watch it once, you maybe you have a conversation with somebody and then like it clicks. You're like, oh, that's why they said that.
Yeah.
Yes.
And each topic kind of within the first time home buyer that we discussed kind of has another topic, within credit and different things like that we can touch on. But once again, that kind of goes back to talking to your mortgage advisor about a plan, getting prepared. And then you go on to your realtor who then gives you that information. You're already prepared for your mortgage and you can work with that person to really solidify the home you want at that point.
Yeah. Wonderful.
Yeah.
Well, I think this was great. And I really want to thank you for your time. Like, thanks so much for coming. And I'm going to put your contact information down below. So if anybody has any questions for Ray, he's always available. He's great. Yeah, I think that's it.
Thank you, Ashley. I appreciate you inviting me. It's, hope to do a couple more of these soon. And, it's always great to see you and chat with you and good experience.
Yeah. Thanks, Ray. Thank you so much. Well, that is it. That is the video. And we'll see you again soon. Take care.
Sounds good. Definitely. Have a good day.